Hello, my friends. Brett Pattison with Iron Gate Global Advisors coming at you from the financial capital of the West. That, my friends, is Salt Lake City, Utah. Thanks for tuning in today for a very important discussion. It's the month of September. It is our market commentary, and we will be addressing fear. Because fear has taken over the market. In fact, fear has taken over the whole world, it seems like. So what should you do? That's the topic of today's short video. We'll discuss why there's so much fear. We'll discuss what happened in the month of August to create this fear. We'll discuss what our approach is to the different types of markets, bullish, bearish, choppy, sideways, and we'll show you how we focus not on returns, but how we focus on a process that we believe in where ultimately the returns take care of themselves. And so that's what we're going to discuss today. To recap August, here's a picture of a little furry fella, actually a big furry fella, who's been sticking his nose into the market a lot lately, creating a lot of fear. In fact, CNNmoney.com puts out a fear and greed index. And here it is. I captured it towards the end of August. And on the far left, extreme fear. On the far right, extreme greed. We are about as fearful as you can possibly be in the market right now. So when we address fear, it in a big way, fear is unfortunately driving a lot of people in their emotions right now. In fact, fear, let's take another look at an index that I follow very closely, and many of you do as well. It's called a volatility index. It's the VIX, if you've heard that. Basically, it's a fear gauge that's tied directly to the S&P 500. And it's tied, in fact, directly to the options on the S&P 500. And it's contrary to the market. So when the S&P 500 is up, the VIX is down. When the S&P 500 is down, the VIX moves up. And it's called a fear gauge because when people are at their, when they become more fearful, they look to the options market to help them. And they go out and they buy puts. And so when the demand for puts increases in a big, big way, this index pops. And that's why we call it a fear index. And so, and I'll leave out all the other details that are not important right now. What's important is the higher this index is, the more fear that exists in the market. And you can see that on the left edge is 2008. On the right edge is where we are now. And this index hit a high of 53.29. That's the highest this index has been since the financial crisis. Now, I want you to think about that for just a moment. Fear, just last week, was as high as it was when banks were failing, when capital was frozen, when the world was in a deep, dark recession. That's the same type of fear that we saw a couple weeks ago. Now ask yourself the question, are we living in a 2008? Right? Are we living in a 2008? Most of you should say no, we're not. But fear, people's inherent emotions were the same as they were back to 2008, 2009. And much of that is what we call recency bias. See, recency bias is when you focus so much on the recent past that you forget, you forget what happened 30 years ago. You focus so much what happened on, 5, 10 years ago. And that's that recency bias. And people are still scarred from 2008 and in a way that I haven't seen fear just creep into the market that quick, that fast. Well, since banks were failing back in 2008. Now, here's the thing about fear. One of my favorite quotes of all time comes from the man known as the Oracle. The Oracle of Omaha, it's Warren Buffett, and he said this regarding fear. I show you this so you understand kind of where we're coming from, right, as far as how to take advantage of fear. He says 2 super contagious diseases, fear and greed, will forever occur in the investment community. The timing of these epidemics will be unpredictable. Okay, that's great. We know that. It is unpredictable. Here's my favorite part. We simply attempt to be fearful when others are greedy and to be greedy when others are fearful. That's the key if you want the Buffett mentality, right? It's to be fearful when others are greedy and greedy when others are fearful. And how do we do that? Well, let's go back to the S&P 500 and that VIX. And you can see the VIX is at the bottom, the S&P 500 is at the top. And this kind of makes me excited. I'll show you this, and I'll show you why I'm kind of excited right now. But it goes back to 2008, and you can see when the VIX is high, the S&P 500 has pulled back quite a bit. And that arrow tells you when fear is increased in the market and when it's time to get greedy. Now, timing is never perfect, right? But if you're buying at the bottom or when the VIX popped to 65, 70, even 55, even 45 back in 2008-9, pretty darn good time to buy. In fact, 2010, we saw the same thing. VIX spikes, and that was a low in the market to where it was a great buying opportunity. 2011, same thing. 2011, when the U.S. debt was downgraded from AAA to AA+, right? A lot of fear came in, great buying opportunity. And today, and there's a question mark because we never know until after the fact, but we've got that same type of fear, that same type of potential buying opportunity happening right now. All right, so I'll address what we're doing specifically in a moment, but let's talk about why there's so much fear. Here's why there's so much fear in the market. Here's why the market is sold off. Compare this to your 2008 notes. All right, your mental notes as to what happened in 2008 to see if the fear should be similar. And the first thing is the China bear market. China's slowing down. We've been talking about this on multiple videos. We've blogged about it. If you haven't read our blog post, do, because China's slowing down. The interesting thing about China is, and the fear is that if China slows down, well, that will have such a huge drag on the U.S. that it will slow down the U.S. But the fact is, if you look in the numbers, only 0.7% of our GDP is tied to U.S. exports to China. Only 0.7% of our GDP. So we know China's slowing down. It's no secret. It's been slowing down for some time now. It shouldn't have that big of an impact on the U.S. 0.7% of our GDP is tied to those exports going to China, right? So even if the China bear market continues and gets even worse, shouldn't drag us down too much, right? The other fear that exists is the Fed possibly raising rates in September. It's the going from, I don't know, the Fed funds rate is somewhere between 0 and a quarter point, and they will rate it to they'll raise it to a quarter point. So that's the fear, is that raising rates will slow down the economy as well. I created a video. It's on YouTube. It's called 3 Things to Know When Interest Rates Move Higher. If you watch that 8-minute video, you'll find out that raising rates historically has not been bearish. It has, in fact, been bullish. So I urge you to click on YouTube, find that. Just type in Iron Gate Global Advisors, find that video, check it out, and it'll be an aha moment for you, I'm sure, if you haven't watched it. The third thing that's caused a lot of fear are just algorithms and robots. We live in a high-frequency trading, not investing, but trading world, and sometimes those algorithms, when there's a lot of volatility, help increase the volatility. It has effects upon ETFs. It has effects certainly upon individual stocks. We saw an 1,100 The Dow was down 1,100 points at the open on what they're now calling Black Monday. And a large part of that was due to algorithms, right? And those robots failing us. So that's the main reason why fear exists. Those first two bullet points being the main reason. So with that fear in mind, how did August fare? Well, there's your August percent returns for the global markets. Ugly. Let's call it what it is. It's very, very ugly. The U.S. down 6 plus, the developed non-U.S., that's developed Europe, developed Asia, a little bit of Australia, that's down. Emerging markets down 9%. Everything's down. The all-world country index, which is one of our benchmarks, along with the S&P, was also down nearly 7%. The emerging markets leading the way. In our positive year-to-date returns, well, they're now negative, right? The S&P's now down as of August 31, down 4%. Developed non-U.S. still leading the way, down nearly 2%. Emerging markets just being hammered, and the all-world country index down 4.5%. So there's where we stand in August. There's where we stand year to date. Not great. Not great at all. We like to see positive returns, obviously. Now, as far as sectors go, here's what happened in the sector world. Utilities actually held the way, and that makes sense. It's a more defensive sector. So it dropped the least in August, but you can see all those returns are pretty ugly. Pretty darn ugly. In fact, healthcare, which has been the leading sector for the entire year, was hit the most. And I'll talk about why here in just a second. But year-to-date returns, we have consumer discretionary and we have healthcare still leading the way. We are currently overweight healthcare, and we're overweight consumer staples. We typically are this time of year because it is a volatile time of the year historically. So we shift from being more risk on to more risk off, and have more defensive, overweight to more defensive sectors this time of year. And it's, I would say nothing's worked, but it's worked better than the alternative. But you can look at healthcare. That's interesting. Let's talk about healthcare for a moment. Healthcare was the leading sector for the year. All right. Of course, you've got energy, which is getting hit the worst, down 16%. But energy was the leading sector for the year going into August, and it had the worst performance. And if you think about that, it makes sense. When people are fearful, they're going to take their gains off the table. And if there's a lot of gains in healthcare, then that's going to be hit the hardest because that's where everybody has those gains, right? Take the profits off the table is the saying for traders more than investors. And that's what happened with healthcare. So I'm not really concerned about healthcare from the sense of, hey, that was a huge sell-off in August. Still love it. Still overweight that healthcare sector, right? Still defensive type sector as well. So that's the August update. Nothing pretty, all pretty darn ugly as far as those returns go. Now, here's something that we need to address, and that is going forward, what do we think is going to happen, right? And when I say going forward and planning for the future, Brian and I at Iron Gate, we have a process in place. And that process, again, don't focus on the returns, focus on the process. And that process includes, for a large part of our clientele, preservation of capital. When the you-know-what hits the fan, it's important to preserve capital for those that are a little bit older so that if a bear market comes, there's not a huge drawdown in their portfolio. So that's what we call our portfolio protection strategy. This does not apply to everybody. It applies to those whose goal is to preserve capital. Number one or number two goal is to preserve capital. And this is taken directly from our website, this chart, and I'll show it to you. Our portfolio protection strategy involves two moving averages. It's a technical-based strategy, all right? And it tells you when the shorter-term moving average crosses below the longer-term moving average, then there's an exit signal that triggers, and we take most of our, not most, but yeah, you can say most of that ETF allocation that we have in different portfolios, and we move more to cash. And you can see back and this is 1999 through 2003, this chart, and the signal came. We lost 13% when the signal comes, and the S&P 500 drawdown ended up being 47%. So preservation of capital. Yeah, you lost, and you're probably always going to have some sort of drawdown, but you lost significantly less than the market. Here's another example. Back in 2006 through 9, you can see in 2007 that exit signal came. Yeah, you lost. You lost about 17%, but the S&P 500 drawdown was 56%. So it's not that we're guaranteeing, and we would never guarantee that everybody makes money, but it reduces the amount that you can potentially lose, and it preserves capital. That's the strategy. So I give you that background to show you where we are today. Here's the United States, is represented by the S&P 500 ETF, SPY, and you can see on the right edge of that chart that shorter-term moving average has crossed below the long-term moving average. Now that triggers that bearish indicator, and so and a lot of clients, not all clients, but a lot of clients have noticed in their portfolios the scaling out of some ETF positions. That's why that's occurring, right? We don't dump everything at once. We would never do that, but we scale out over the course of a few weeks. There's the United States. You can look at the developed non-US, same thing. This shorter-term moving average crosses below the long-term moving average. And the emerging markets, that happened a while ago, and I also have a little trend line for the technicians out there, broke a pretty significant trend line, and we've been out of emerging markets since then, right? So that's the signal to get out or scale out of not your entire portfolio, but certainly a portion, as much as you need to preserve that capital, right? And so that's where we stand now. But here's the thing. Simply by this indicator crossing does not mean we're bearish. It means, okay, let's take some risk off the table. Let's be a little bit more careful, because we know that corrections in the market are normal. Okay? And when I say stock market corrections, a correction is a 10%, a 10% move downward in the S&P 500 or the Dow or the NASDAQ or a global index or whatever it may be. Stock market corrections are normal. In fact, the average days between two 10% corrections, and this is from S&P, Deutsche Bank, is 357 days. Every 357 days, there's a stock market correction. All right? Now, here's the interesting thing. Since the last correction, we've gone 916 days. So you could argue that a market correction is long overdue. It's healthy, in fact, that we go through this. And it's just the normal bull market, the way the bull market moves. All right? So that's the argument. We'll never know until after it happens, but that's what a stock market correction is, and know that it happens, once a year at least, right? On average. It's been a lot longer than that, this current run, though. Let's take a look at the last correction, 2011. Okay, and I'm gonna blow this up a little bit so I can show you the risk reward of this portfolio protection strategy. And you can see back in 2011 that this shorter term moving average crossed below the long term. Okay, bearish signal. Time to start reducing risk, preserving capital. Okay, let's do that. Well, the downgrade comes, volatility increases, and what happens? It was just a great buying opportunity. And then the 10 crosses above, the short-term moving average crosses above the long-term moving average, and that's a buy signal. And so you buy. And so at that point, you're selling at a low, and you're buying at a high, which is not what you want, right? So for those that need to preserve capital, know that doing that, we could be timing it perfectly, meaning if there's a bear market around the corner, we're moving more in cash and some other things that we'll talk about. Or this could just be a correction, right, to where we're just going to buy back in a couple weeks or a couple months. Nobody knows. That's the thing. But know that there are pros and cons to preserving that capital. And it's a process that works. You know, if you're 70, 75, 80 years old, or 60 or 65 and you're in retirement, or 55 and you're in retirement, and you need to preserve capital, it's a great way to do that while still allowing growth. All right? So keep that in mind, and it's important to keep that in mind. Now, the next thing we'll talk about are market fundamentals. See, we're the belief that my gut tells me this is just a market correction, nothing more. Because I look at the market fundamentals, and most of these came out last week, right? You have GDP increasing, you have personal income increasing year over year, you have single-family homes doing very well, housing starts increasing, durable goods increasing, the valuations on stocks, they're not cheap, they're not expensive, they're fairly valued. So it's not like, we're in this huge valuation bubble. This is completely different than 2008, where cracks were all over the foundation. So because of that, I believe we're in stock market correction mode. All right. So what do we do? Here's what we do. In a bullish market, here's the process. In a bullish market, I have these arrows. These arrows indicate what we have a lot of, right? So in a bullish market, we're going to have a lot of value stocks, that are growing, hopefully. We're going to have ETFs, and we're going to crank down the allocation to options and to cash. We're going to be mostly long stocks and ETFs. That's what we do in a bullish market. In a bearish market, you can see a couple things here. Look at the ETF sector rotation. That's what we just talked about. We scale back that. We up the options because volatility increases, and it's better to sell options when volatility increases. We increase cash. And we notice the arrow on the value stock. It's kind of sideways, meaning we still look for these great investing ideas of these tremendous companies that have been just hammered for no good reason. We will still allocate cash to good value stocks. We're not going to ever stop that. That's a key important thing. That's when you're greedy, when others are fearful. Right? You don't stop everything, but our process tells us, look for those stocks. Let's keep doing it. Let's keep buying those great stocks. Now, when there's a choppy market or a sideways market, we'll continue to do the value stock. There's not much change there. We may scale down the allocation to ETFs. We'll up options and selling options because volatility increases and cash will be ultimately the same. Right? May increase a little bit, but that's the process at its core when a bullish market, a bearish market, a choppy market exist. Okay? And if you have questions on that, email me at brett@igga.com and I'll go over it with you a little bit more if you'd like. Okay? Now, the last thing that I will cover today, the last piece of advice is a couple things. I could sit here for another hour and give you some advice as to what's happening in the market. But here's a little section of an email that we sent out to clients 2 weeks ago. It said, we will not let a 5-day or a 5-month bear market destroy a 5 or a 10 or a 30-year plan. Okay? We simply won't do that. We will not let fear dictate how we manage money. I taught retail investors and investment advisors for over 10 years. And I will tell you the number one reason why they fell, and most retail investors do, very few are successful at it. The reason why they fell is because they let emotions drive their decisions, not the process. The last piece of advice is respect the process that we have in place. Certainly more than happy to address anybody's portfolio that are clients. If you're not a client, more than happy to have a discussion with you as well. All right, so respect the process. Know that we think this is a correction, but also know that we think that we will follow the process that we have in place that we firmly believe in. Okay. That said, a lot of information now on our education center and on our blog. When things happen in the market, I will write a blog post that tells you what we're thinking. So there's complete transparency in what's taking place. If you have any questions, feel free to email me. There's my information, Twitter, LinkedIn. More than happy, again, to have any conversations with you. If the fear has you thinking things and doing things that you shouldn't be doing, then reach out. Let's have that conversation. We appreciate all of our clients at Iron Gate Global Advisors. It's because of you that we come to work every day. We take our job serious, and we seriously appreciate the trust that people put in us. I hope you're seeing that in your portfolios. That said, until next month, my friends, see ya.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and/or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.